Hey, welcome back to Real Estate Talk Podcast. Rob Keilman.
Joshua Britt.
All right, guys, we got one of our former guests on, commercial real estate guru, and it's Mark Leverett from BPM, and he is joining us from San Francisco, right?
Good morning.
Good
Yeah.
morning. How are you doing
Right
today,
early
Mark?
here.
Awesome, awesome. Hey, thanks for coming on so early. You guys are like 3 hours behind us, so it's 10:19 a.m. right now. Here, you're what, 7:19?
That's right. Yeah.
Oh my God, you're up early.
And I live, 45 minutes away from here, so I had to drive in a
Oh,
little
wow.
earlier, kiss my kids goodbye before they were awake, and made it in.
Well,
All right. We
well,
appreciate that.
yeah. Thanks for joining us. All right, so
Sure.
we're gonna talk a little bit about commercial real estate. Everybody that I know around me talks about residential real estate and housing a lot, but hardly ever do I get to hear a lot of people talk about commercial real estate for the masses. So it's great to have an expert in commercial real estate like you coming on, where we'll get to ask you some questions, and especially those who are interested in commercial real estate. So looking at current trends, what's going on, what are emerging topics on on the analytical sites, and one of the things that come up, Mark, is office vacancy rates. So with office vacancy rates hitting record highs in San Francisco and across the U.S., is the traditional office space model dead forever? What radical changes do landlords need to make to survive this downturn?
Yeah, I mean, this is what we talk about in San Francisco. My practice is nationwide, so I get to learn about all kinds of markets. San Francisco has certainly been in the news for a long time, how quickly we vacated our offices and how deep that has stayed for a while. San Francisco is coming back. I know that that's a media discussion as well. We've heard San Francisco will rise from the ashes. In fact, the flag of San Francisco is a phoenix rising out of the ashes, and that was actually created before the 1906 earthquake and burning of the city. I mean, we already were that, and they had foreseen. San Francisco's back, slowly progressing on the vacancy that you're talking about, but I went to a CBRE presentation recently.
What's CBRE?
CBRE is a large real estate consulting firm that they do everything from property management to helping owners make decisions about where to buy. They have tons of data around commercial real estate, and there is an individual in their data department that looks specifically, focuses on all metros, but tech talent. So talking about technology companies that have headcount and they need real estate. And there's a lot of topics I'm sure we'll touch on about why there's density in office, but your question is really about what are we doing in San Francisco to make changes to get people back? One of the changes is that venture capital money is coming into the Silicon Valley in huge droves. It's the focal point for AI. In fact, something like 85% of the venture capital money for AI is coming into this area, San Francisco, Silicon Valley, and yeah, it gets dispersed countrywide, worldwide from here, but we've got headquartered AI companies that are making a difference, and they want certain types of space. So I would say that the main thing that they want is a high-end, super nice office space that has communal areas and amenities that attract employees. So absorption of that vacant space right now is it's difficult because most of it's actually already taken. All of the very high-end Class A commercial, but they're going to places like down the peninsula. They're going into Mission Bay in San Francisco, which was a fairly new developed area with very nice office, and they're filling that up. The absorption rates are way faster than when we last talked, which I think was a year ago. Way quicker than anybody expected. And we'll probably be able to refill the San Francisco vacancy in the next 5 to 7 years if we keep at this pace. So that's what we're hearing. It's way faster than the 15 to 20 years that we talked about last time. So this is good.
Awesome. So San Francisco's downtown recovery. Okay, San Francisco's downtown San Francisco's downtown has been hammered by tech layoffs and empty offices. I've heard things like everything from like Meta's laying off to other tech companies laying off. Maybe a lot of it due to the AI surgence, and like former Zendesk headquarter heading to auction at a massive discount. What is your bold prediction for the revival of San Francisco's commercial core in the next 12 months?
I mean, that space you're talking about with Zendesk is very nice. It's in the great part of the city. I don't think it's going to be too much trouble now that we have so many tenants knocking on doors looking for that space. I actually think that the CBRE presentation that, I think you can find this online. Go to CBRE's website, look for the tech talent report. I think it's out there for the masses. But they are comparing the .com trajectory of square footage absorption. So how quickly does the vacant space get leased up? And then they're looking at the app era, the mobile and app era, which ran from 2008 to 2019, how quick the absorption is happening. Right now with AI, that absorption is even faster. And the belief is that we're at the front edge of this new era. So we've got faster absorption, maybe a longer period of time that we're going to see need in the markets. San Francisco is the pinnacle of it. So I think San Francisco is coming back faster than anybody even projects currently.
Okay.
This is interesting, Mark. I heard Warren Buffett say this probably a year, maybe 18 months ago. He said about commercial real estate that the buildings will remain, but the names on the buildings will change. And I think that's kind of what you're alluding to is that, some of these major players, Zendesk, for example, they no longer are going to own that building, but somebody else will come in and fill that vacancy, and they'll take it over and take it to the next level. Is that kind of what you're
That's right.
towards?
That's exactly right. I mean, many of these buildings have been here and filled and then vacant and then filled again, over decades, and it'll happen again.
Okay. I do got one question for you real quick while we're right here. So what is the ugly truth in commercial real estate right now that nobody wants to talk about? Like, what's that elephant in the room?
I think that we're not talking about it enough, but there's this wall of maturities of commercial mortgage-backed securities and just the debt that is sitting on this office that we're talking about that's vacant. And when that debt comes due, somebody needs to pay it off, or they're going to get foreclosed on, or there's going to be other catastrophes that happen. So there's concern about that. If the asset values remain as low and the debt comes due, we're going to feel the effect significantly across the country, probably the world. But if asset values come back fast enough, hey, we might thread the needle. Let's see.
What's your prediction?
I think we're going to come back faster than anybody expects, and I think that there's going to be some pain, but I think a lot of the balance sheets of the holders of this debt and these assets have already taken a pretty big beating. I think the investors know what's coming. I think the smart people really understand what's going on. There may be not enough discussion about it outside of that group, and so maybe unexpected by some of the tertiary groups involved.
All right. Well, I'm gonna keep going with going back to AI and data centers. Data centers are exploding with near zero vacancy rates due to AI demands. How is this reshaping commercial real estate, and could it be the savior for struggling markets like the Bay Area?
Well, what's interesting is data centers are not really located in the Bay Area. They're located in other markets that have more energy, and lower cost of land. But then also they need to be in proximity of where these uh, um, dark fiber infrastructures exist, a plug between the East Coast and the West Coast, and get use out of the data centers. But the data centers aren't typically here. I think there are smaller ones. Obviously, there's a lot of R&D happening where they need to house these things, but the big ones are located in other markets. Texas, I know, has one of the biggest being put in now. Um, the thing is, you need to have people that are innovating on what that is going to be, and they can be anywhere in the world.
Mhm.
It turns out that they are here in San Francisco or the Silicon Valley, and that is because follow the money. The money is coming in to the United States through the Silicon Valley, and some of the stats, like I said, 83% of all of the funds that are pointed at AI are coming here. They're landing in bank accounts controlled by headquartered venture-backed companies here, the biggest of which, may arguably is OpenAI, but other companies that are located here, the big names, Google and Meta and Salesforce, and these things are also located here, and they command quite a bit of the data center money as well. And so you need headcount. And I know we'll talk a little bit about headcount and that later on, but this is where the headcount needs to be. People are moving back to the Bay Area. So I think that investment, those data centers, wherever they're going to be, are going to migrate quality capital people here to the Bay Area. And we're seeing that in a variety of different places. Residential real estate in the Bay Area is starting to come back. There was an article recently about San Francisco rents, and that there's now a bidding war on apartments in San Francisco.
Wow.
And so landlords are coming in and saying, wow, I'm going to increase my rent 10%, 12%. And then people are coming in and offering up to 30% above that in order to be able to secure the apartments in the right locations. So this is the canary in the coal mine, for what's happening in San Francisco. What's interesting, right across the bay in Oakland, it's not happening yet, but it should. By economic means, we should see the effects of San Francisco trail over to Oakland and other cities that are in proximity.
All right. I can't believe people are getting multiple offers on apartment rentals. That's crazy.
Yeah.
I never seen that before.
It's interesting, and I think more or less what you're getting to about Oakland, how it should transfer over, it probably will, but it's just going to take a matter of time. And once the vacancies get filled in San Francisco, Oakland will probably see it next. So would it be, would you be advising your clients that maybe start looking into the Oakland market?
I would. I think there's great transportation to come in from a wide area around the Bay Area. I mean, we have Bay Area Rapid Transit. It's called BART. We call it BART. It's a train that's been around since the 60s, and it goes as far south as San Jose, and it goes all the way out to Pleasanton, which is way past Oakland. So all of these markets, as the boom and bust cycles happen, typically the increase in asset value and rents, it goes further out, and then it contracts back into San Francisco. I think San Francisco got really hit because of the pandemic, and literally people fled the city. It was concerning to be in San Francisco. The homelessness was terrible. Crime was rampant. I had two little kids. Well, I had one little kid at the time. I have a second since leaving San Francisco. But when I lived here, when the pandemic hit, it was scary. And finally, we've got an amazing mayor that is stepping in and making change in the city. Plus, just economic reality. This is the center of the universe for many reasons. So, for that reason, San Francisco is going to affect all of the other markets.
Yeah, that's a big statement right there. You're the center of the universe. Wow.
Hey, clickbait.
All right, we're going to transition to interest rates. You know, because everybody don't like them the way they are right now. They like them a lot lower. So, with interest rate struggles, mortgage rates are stuck in the mid 6% range, squeezing commercial deals. What's the biggest mistake investors are making right now, and how can they turn high rates into an opportunity?
Yeah, well, my brother's a residential real estate broker, and he always says, "Date your mortgage, but marry your house." That's the thing. These interest rates, relatively across a 40-year horizon, are actually pretty average or modestly low at points. But these are temporary, and it does seem like there is a view that interest rates should come back down in the future. So, I think that finding quality assets, finding the right debt to go with it, is important. Some people can't get out of their asset or get out of their debt; they're upside down, and they have to come to reality with it and let that asset go. But others, if you're seeing great assets out there, find the right partner in your capital stack for debt, whatever the interest is, because that asset will be yours, into what I think is a very positive future. So it depends on what type of asset class you're looking at, but we've been talking about commercial office. I think this is a real opportunity right now to figure out how to buy some of these assets where there's a willingness to let them go at historically low values.
Mark, this is kind of interesting because I literally just had a conversation about an hour ago about the same thing right here. But I don't know what the number is for commercial, but for residential real estate, they say over the last 40 years, it's been about 7% is the average interest rate, right? Where is it in commercial? And I have to tell you, I disagree. I don't think that just because the feds are going to reduce the rates, that the banks are going to pass the savings on to the consumers. So I disagree with that right there. And I think there's a lot of people who have this misconception that because the Fed might lower rate, that is going to help lower rates for people borrowing money from the bank. I don't think that's going to happen
You
at all.
you said it perfectly, and we don't know what the spread will be between what the Fed sets and what the market will require. And I know that you guys are flippers in the market, and that you do transactions with some real estate that has some hair on it, and you need different timelines on your debt, and so you understand that there's different uh, uh, partners out there to provide that liquidity to you for different periods of time. Similarly, in commercial real estate, you're going to have either a class A super quality asset that is very easy to predict what the cash flow is going to be on it. You're going to be able to go to one of the biggest institutions out there, like Chase or Wells Fargo, and get the lowest rate and for the longest period of time on that asset. But there's other assets that are not as clearly defined, and you might need to go to a more creative bank, or debt fund. There's a growing private equity market to provide this liquidity for investors, and debt has a big range, and it does depend on the underwriting of what that asset looks like, and the belief from whoever it is you're going to partner with to take on that debt. But there's a big wall of capital waiting to come in at the right interest rates. They just need to underwrite it. And in order to get that underwriting, you have to have a track record. You have to have your own balance sheet helps a lot. You can have a guarantor involved in order to bring down the interest rates, and you need high quality financial statements. So the quality of your financial statements is going to reflect on your ability to get debt. I know you were asking what is that interest rate right now, and I
Yep, I'm
probably could
waiting.
go look it up. But
I'm
like
on
I said,
edge.
it is such a range. I mean, do you want a 5 year, a 10 year? Do you want it just for 6 months to bridge,
Well,
something you're trying
what
to do?
what what does the average person purchase real estate at? Is it a 30-year, 15? Like what does that look like?
Yeah, so in if you're a small business and you want to go buy a piece of property to operate out of, you're going to be able to get a small business loan through a credit union or some debtor, and maybe I don't know the exact numbers, and it also geographic specific too. Um, but that is going to be subsidized in a way that you're going to be able to do that. It probably makes sense for your business and lots of tax benefits, by the way, under this One Big Beautiful Bill Act, or OBBA, as we call it in my CPA firm. I don't know if you guys have heard of OBBA. Have you heard about this thing?
One
No,
big
OBBA.
beautiful bill.
yeah,
Yeah,
I've
yeah.
heard about the bill, but I've never heard it referred to that way. But that's interesting.
Yeah,
Uh,
no,
but
that's
but can you
yeah.
touch on what those savings are that you're speaking on? Because I think that's probably important to some of our listeners.
Yeah, so it locked in a lot of the same benefits that the previous uh, Tax Cuts and Jobs Act. Anyway, I forget what the previous bill was called, but the TCJA was the previous bill that was going to sunset at the end of 2025. Many of the items that you probably use in your business, and many of the listeners listen to, will continue, which is great. But there's also additional things that are real estate specific. I mean, there was a ton of items put into the OBA for real estate. Obviously, I think that the administration loves real estate, and they're a little bit biased, so they put in some things. There were talks about removing some items in the final hours. They were left in, which is great. But you can do qualifying improvements on property and get a bonus depreciation immediately. So if you need a tax deduction in the current year, you can think about improving real estate, getting that value increase, getting a tax deduction today, and then leveraging that additional capital you would have paid in taxes over the course of the ownership of your real estate. Um, there are items like the low income housing tax credit or other energy efficiency credits. Tax credits in general are just, you're making a decision to buy a piece of real estate and you get a deduction on your taxes today. So the government is incentivizing investment in real estate. They also added for real estate investment trusts, which is a growing part of my client mix. There's public REITs and there's private REITs. So individuals that own real estate might put things into a REIT structure in order to give more ability for liquidity. It's better from a tax perspective, but you can actually put in a taxable REIT subsidiary, like a management company, property management, other kinds of businesses inside of the REIT. And the new OBA allows that to be up to 25% of the taxable income of the REIT structure, which is a huge incentive. It's like, hey, real estate owners, now you can put a shelter inside of your REIT. And so we can talk about what that means. But once you're in these structures, whether they're a partnership structure or a REIT structure, you can get all of these benefits that individuals can't get just because you put a structure around your real estate holdings and your investment holdings. So, like I said, it's the tax credits, it's the accelerated depreciation, it's the ability to transact and shelter your taxable income through a tax-deferred exchange, which survived under the act that was possibly going to go away, and that survived. And then the final one, which we saw a big boom in qualified opportunity zones and how you can use a qualified opportunity zone to invest in real estate. That we thought was sunsetting. There was a planned sunset of that. And instead, under the OBA, they decided to double down on it. So now there's more types of assets. There's going to be larger areas that can qualify, and including businesses with the real estate in it inside of these qualified opportunity zones. to invest. So lots of great things in open. And I'm not a tax expert, so I can talk about these things, but actually doing it, I go to my team, and we've got it represents. I think it represents about half of our firm is tax focused consulting and compliance.
All right.
Yeah, thanks for all that.
Yeah. So let's talk about office to residential conversions. So for those out there, it's basically a commercial real estate building that's zoned for commercial use only, where the use is changed from commercial to, say, residential, and maybe transformed into an apartment or maybe a condo. With housing affordability worsening in San Francisco, should we convert more vacant office towers into apartments? What are the hidden challenges and potential windfalls in this trend?
We should definitely convert a lot of these old buildings that the new tenants don't want to move into. We should convert them into other uses. Probably the highest and best use is going to be residential, but it's very difficult to make those types of conversions. We have a large architect client that has been working on this across the country and written a playbook of how to do this. And the thing you need to look at is, what are the ratios of the square footage to windows? How does the air flow? Is there ability to put in plumbing? Because a lot of these office buildings just have one bathroom, right, in like near the elevator core, and so you need to be able to put plumbing throughout the building. It's a big thing, and some of the calculations say no, we should just push these buildings over and start again. But there's come back to tax. There's a lot of tax credits available to doing some of this stuff. So there's historic tax credits that are able to be leveraged. If you save parts of the historic building, if it qualifies, you can use that in order to pay back the investors that are helping you do these things. Beautiful buildings here in San Francisco probably are not the best place for a Databricks or the next Zendesk coming in. They would be beautiful to live in, and that'd be good. Now let's go back to talking about Oakland. Now Oakland has vacancy, and there's tons of units that landlords are giving away for months in order to get them to move in. It's going to be hard to say, let's spend all this money to convert an office to residential, even though it's in San Francisco, versus then just letting that market in Oakland absorb them.
So you were saying that some experts are saying, instead of running the plumbing or the HVAC ducting, because I know you mentioned that, I guess actually it makes sense, because like anytime I'm in a commercial building, where's the toilet? It's going to be in the hallway somewhere, and is it going to be near an elevator? Most likely it will be, and all offices kind of share that bathroom space, so to speak. So wow, I didn't think it would be cheaper to knock down the building than start all over, than to kind of retrofit it. So that's interesting.
Yeah, there's a lot that needs to be done on these buildings to make them habitable. Each city has its own set of regulations that define what is habitable space. So you have to conform with the cities. A lot of these cities are making concessions and changing the zoning or changing the requirements for this, but
Kind of modifying existing rules.
Yeah, modifying existing rules in order to allow this to happen. But there's only so much of the market still. I want my own bathroom. I want to be able to close my door and not, So yeah, it's hard.
Okay. Well, let's move on to talking about blockchain in real estate. So you're a blockchain expert. How could tokenizing commercial properties change the game for investors in 2025? Is this the end of traditional real estate ownership as we know it?
Yes, it is the end of traditional real estate ownership for sure.
Okay.
I mean, I think the administration wants to allow tokenization of a lot more things. I think that there are new rules, both from an accounting perspective and a regulatory perspective. You don't have to be a bank to do some of the stuff that you used to have to do. Trump actually said himself, there was a quote about, owning a piece of Trump Tower and letting the American people, own that. I mean, that is the future of owning real estate. You're going to be able to go to a piece of real estate that you thought was iconic and say, well, I own some of that. I do think that will happen.
That is interesting. I mean, this is a side topic, Josh, but you and I were kind of just talking about this. Where is what was it? Intel, the federal government's to get like a 10% stake in there or something or the other. That's interesting. Where he would say something about that. You can maybe own a percentage of real estate, kind of like fractional investment, so to speak, like where the building is broken down into shares, kind of like. I don't know. I guess kind of like a timeshare in a sense. You have an ownership like interest stake in it.
Stock market.
Is that how that is?
Yeah, it's kind of like the stock market. You own X number of shares, so you get X number of the profits. So that's kind of how the fractional ownership is.
Yeah, man. I would like one share of the Empire State Building, just one, just to say I have an ownership interest in it.
Yeah, no, it's pretty cool what you can do too, because when you think of the traditional ownership of anything, it's like you have the right to get paid back for that. But with crypto and blockchain, you can fractionalize all of the streams of ownership of a building. So for instance, you might be able to own a piece of the land lease, a piece of the operations of the building. You might be able to have a right, because you've got this thing, to go and use an amenity space within the building. You could own a piece of the debt. So you could say, I want to tokenize the debt and I want to tokenize the equity. So you have different returns on the same asset, and you could shift between it. Oh, well, this month I want to be more on the debt side. I'm feeling like the economy is sluggish. I'm going to reduce my risk from the equity side. Oh, I'm going to shift it over to the equity side. And you don't have to go and pay all of this infrastructure, the middlemen of the economic engine, to shift all these things. You could literally go to a wallet and shift it. So that's what we're hearing about. It doesn't exist. There's a couple companies that are doing some of this stuff, but this is going to come, and you can have the Empire State Building and do that. It's up to you.
It would be awesome if I can take like some Solana and convert it and then buy shares of a building with it. Do you think that would happen?
On a Saturday at 8:00 at night, you could do it instead of waiting till Monday morning.
Yeah,
so that's the future of blockchain.
Oh man, I can't wait. I'm probably gonna be an old man by the time that happens, but we'll see. With the way data centers are going and the way the AI push is, I think stuff like smart contracts, stuff like tokenization and stuff like. I think this is going to be great. I am excited about that actually as a potential. This is a different way to buy real estate. Instead of buying the whole, banana, you can just buy parts of it, and then maybe I want to own a little bit of this building, or I wonder if like national parks that will be in it. I don't know. That's kind of government related. Sorry, I'm getting ahead of myself.
I really hope that.
I'm getting ahead of myself. Okay, so multifamily surge. So let's talk about multifamily. As we kind of talked a little bit about it with conversions, but apartment sales jumped to 35 billion in Q2 2025. What's fueling this multifamily boom? And is it a bubble waiting to burst amid economic uncertainty?
There's not enough housing in this country. That is for real. And we need to continue to develop. And this, the increase in values that are happening in certain markets is the tale of people wanting to live in those markets. There's problems on the debt side and the capital appreciation side that is holding back that development. There are reasons why certain markets are doing extremely well. I don't want to start naming names, but I will say that people are moving to San Francisco, and we mentioned the increase in rents in San Francisco because of that. That's multifamily. That's some single family homes. San Francisco has a lot of multifamily. And we're actually seeing development all the way down the peninsula still for multifamily. I mean, we're in a housing crisis, and we need those units people don't like cramming into the same unit in the United States. We do it. We do it at different times we graduate from college, we don't want to move home, cram. I lived with 6 people in one apartment, 4 bedrooms. We do these things. Other times in economic cycles, we can reduce that density, and clearly at different parts of your, as you're growing up, you want to have more space and less space. So multifamily is a great asset. I'm bullish on multifamily, and especially in those markets where you believe the population's moving. And that's ground up, but there's a lot of really high quality assets that can be value add. You can take it from the class B to a class A minus, and I think that you're going to be able to start building again.
So my take on multifamily is I think that there are certain markets where it's oversaturated, and I think that unfortunately we build in certain areas and it's like the field of dreams. If you build it, they will come type thing, right? But I just don't know if people are going to flock back to those old stomping grounds and go back to where their roots were. I'm not sold on it yet.
Yeah, I agree. There's some weather patterns that might affect people wanting to go
Yes.
back to certain areas too.
Not only weather patterns, there's political patterns also. There are some people, and I mean, we've seen it during COVID, where we had a lot of people who were leaving California and coming to Virginia, and they were selling multi-million-dollar homes in California and coming here and buying $1 million
straight up
home cash, right?
Yeah, because you can get an oceanside like 10-bedroom house for like $5 million.
Yes,
on the Atlantic
maybe
Ocean.
even a 20 bedroom building for or 20 bedroom house for $5 million.
Yeah.
I would just recently lost a residential deal here where my client's well qualified, but it's not all cash, but somebody came in over the top all cash. Like, it's hard for people to compete with that, but it is the reality. I think the political layout of the land, if you will, is also affecting the migration patterns within inside the country.
Well, definitely. I mean, do you measure when you're talking Virginia Beach? Are you measuring the land plus like bedrooms to be able to calculate what a house is worth? Are you using square footage? Are you measuring what is the main driver?
So I think that it's unique because, for one, I've always felt that Virginia Beach, this area, was underpriced for a very long time. When you look at other areas that are on the water, on the ocean, and you look up and down the East Coast and you look up and down the West Coast, this place here is significantly less than most other places on the water.
Yeah, in the area that I live, we measure square living space, square feet of living space, and it's typically 1,000 to 1,500 a square foot.
No,
For
we're
a
nowhere
home.
near that. We're nowhere near that. And I get what you're saying, but the other problem is when you're talking about square footage, you can have the biggest house in an area and try to sell it for the most amount of money, but if you're looking for comps that don't exist, it doesn't support the higher price. It's kind of what you were saying about the valuations of commercial assets and the debt becoming due. If the rest of the area doesn't come up, the value of that debt doesn't go up either, or that asset, right? That asset doesn't appreciate. So then it never balances out and the debt becomes due and it doesn't make sense for anyone to purchase it. So it goes back to the bank. But same thing
Yeah.
happens in residential real estate as well, where I could have the nicest house in an area, but it's only worth what someone's willing to pay.
The nice
If you
thing
look,
about residential real estate is that you can get a 30-year fixed mortgage,
yes,
and you kind of know if your job stays, where it's at, and you can increase it, your lifestyle can stay the same. In some countries, just across the border in Canada, the average the average mortgage debt is something like 5 to 10 years. They don't have 30-year mortgages. So that really affects people because all of a sudden, if the property value adjusts, it's just like what I was talking about in commercial real estate. They may need to make the decision to move out of the place because they all of a sudden have a new debt cost twice as much. We call it in California the golden handcuffs. I mean, I think it's nationwide. If you got a 30-year mortgage on something that's appreciated significantly, it's hard for you to move out of your place and buy something else without having a significant increase in your monthly cost.
That is correct.
I got a little wild ball question for you, Mark.
Oh, no.
Did you see all the hoopla about Cracker Barrel? You guys got Cracker Barrel over there on the West Coast?
We do not, but I did see some of the hoopla.
Okay, well here's what I want to know. So, you look at McDonald's, you look at Wendy's, you look at Taco Bell, and I don't want to date you on your age a little bit, but you look somewhere around my age. So, I remember Taco Bell's used to look like a Mexican restaurant. It used to have like a little bell. It used to be kind of a adobe shape. I don't know how to classify that. And then McDonald's had the golden arches, and then it had all those lights on the roof. You saw them, those like rectangular lights.
Yeah.
But now they kind of they're taking away those characters that define it, because let's say Taco Bell goes out of business, and then you got that Mexican restaurant looking thing. What other business can occupy it, right? At that point, another Mexican restaurant maybe, or if you have an old McDonald's building or an old Pizza Hut building with a distinct roof. I mean, is that hard in commercial real estate? Because I don't sell commercial real estate. So, like, is that difficult in commercial real estate trying to get rid of a building? Is that why a lot of the buildings kind of all look rectangular the same? Because I had a Burger King that was rectangular by right around my house, and then they changed it to a Mexican restaurant, but it looks like it never was a Burger King building. So
That's an interesting question. I don't know that that's why they're changing the branding, but I was interested to hear your take on the Cracker Barrel situation.
Well, it's a nostalgic thing. Yeah, I mean, when I was a kid, I grew up in the Midwest, which was like Indiana, Chicagoland area. We had some Cracker Barrel around there, so I wasn't surprised to see it when I moved to Virginia. But it was kind of nostalgic because you were a kid. You were playing with checkerboard and everything like that. The big checkers on the rocking chairs. Then you had that, country store, and it was cheesy. It was cluttered, but that's part of the charm, I think. And so when they were changing it, I wasn't, if I was looking at my opinion here, I wasn't quite concerned about the paint scheme. I actually thought a brighter color would be good. But I think if you take away that brand identity, it lessens the brand, and I think it just dilutes what's made it special to begin with. I don't know. I would say instead of rebranding the character, just hit stop, reset, and get a whole new brand altogether. So because your established audience is going to get really pissed at you, and they're going to probably not want to be customers anymore. So
it seems like people are pretty pissed about the changes at Cracker Barrel, which
they took the cracker and the barrel out, but then they brought him back, so now he's no longer unemployed.
And it's supposedly it cost them quite a bit of money in order to do and then undo that.
Yeah.
But going back to the buildings, I don't know that brands are making decisions because of the value of the real estate later or the ability to change the real estate. But I have been involved with a few private equity transactions that come into a fast food chain and separate the real estate out from the restaurant ownership. A lot of it is because they moved to a franchise model, and the franchise model, they don't need to own the real estate anymore. And quite frankly, private equity sees that the real estate is undervalued within the business. And so separating the two assets out creates value. Other times they'll separate it out and then shut stores down too. I mean, if it's owned by the company, and I can imagine not having the Taco Bell arch on that piece of real estate would be useful. So you might be onto something. They're planning ahead.
Maybe. Since we're talking about slightly, I guess, sensitive topics, let's talk about something even sensitive as well, and that's sustainability. Some people don't buy off in the ESG stuff and whatever, but I wanted to ask this question. With global trends emphasizing green buildings, how are commercial real estate players in high vacancy areas like San Francisco adapting to ESG demands? What's one eco innovation that could flip the market? Do you see anything in that space?
Well, it's definitely a discussion with the investor community, and especially when you move to a global investment community. In Europe, there is a focus on sustainability, ESG, and they will only invest if certain metrics are met. And many of those metrics are certified here, like in San Francisco. Virtually all of the buildings are LEED Platinum certified. Um, there are some tax benefits you get from doing these things as well. So all of that additional investment to bring the quality of the air up, to reduce the energy footprint of the building, to offset your carbon emissions, all of that results in not only tax deductions but tax credits. And so that approach to investing, so you attract better investors and you get tax benefits, it's a perfect marriage. And so if you're a savvy owner of commercial real estate, you will look at the benefits to being ESG. Plus, I just think it's good for the world. And if we want some of those low-lying territories around the U.S. to not be flooded as the oceans rise, I mean, we got to start dealing with it now.
Yeah. Plus, well, I won't bring it up now, but I was thinking something to do with home insurance rates too. Actually, weren't we talking, Joshua, to a couple builders not too long ago, and they were telling us about the green things that they have to incorporate now when they build new construction homes?
They don't have to. However, they were kicking around the idea of seeing whether or not it was more cost effective for the home buyer for them to install it during the construction, vice waiting till after the fact and then having those items purchased from some third, party vendor that sells solar panels and then install them. So they were looking at the possibility of installing all the connections, all the hookups, so that way it could be in place. So that way it would lessen the time and the cost for putting on solar panels. But we've had appraisers on this show, and they've told us flat out that solar panels do not increase the value of your home, no matter what that salesperson tells you.
Well, not in our area. I can't say the same for, say, California or I don't know,
I don't know,
Arizona.
Mark. What do you think, Mark? Are you willing to spend more? Are you willing to spend $60,000 more to buy a house that has solar panels?
$25,000 more on a 60,000. I don't know what the math is, but some amount more. I mean, that's just economics. So you got a house. We got two houses built same time. One house has solar panels, one does not. I'll pay more for the one with solar panels. So that appraiser, it has a point. And my brother, longtime broker, my mother, longtime broker, my dad, a longtime broker, used to tell me the same thing about all kinds of additions to homes. It is not going to be value accretive to the home. Don't do that. But I do think that marketability, especially as any asset gets into a market where there's not as many buyers and sellers talking to each other. That's what's happening in residential, it seems, right now. There's kind of this not as much volume on the market in the San Francisco area. Buyers are kind of waiting for mortgage rates to come down. There's not as much activity, so you got to make your asset look better. Maybe there is a point in putting it on, but if you're only going to get 50% of that value back in the sale, probably not a good way to do it. But if you need to unload your asset, maybe.
It is the worst investment of your money that you can do. Like,
It's
literally,
a pain point for us.
you can find other things to put your money into that will actually make you money, because a lot of these people who are putting solar panels on, they get told like, oh, you're not going to have to pay an energy bill, or it's going to be significantly reduced. But meanwhile, all you're doing is taking the money that you would pay the electric company and paying some solar panel company to finance those solar panels over 30 years at an exorbitant interest rate. And now that the green energy tax credit is gone, it doesn't make sense. Never did make sense.
Well,
Not
I run many calculations on the return on investment when you compare it to current energy uses. And we do that for large commercial installs as well. So there is math behind it that can make sense, but make sure that you're looking at that math, as a buyer, whoever's doing that, and make sure it really does make sense. I mean, if you're selling your house tomorrow, I think obviously your point is well taken. You're not going to get the money back. But if you're going to actually get the utility of saving on your electricity bills, possibly. I'll throw in one other
But
interesting
they're
thing.
not really saving. They're just paying the money to some bank that is financing the solar panels. They're
If
not
you're
actually
financing
saving
it,
money.
yeah. But if you
Yeah.
put down if you have $40,000 in your bank and you can buy something that goes on your roof that pays you back over 5 years plus a return, then do it. I mean, that makes sense. And I mean, with the tax savings you get 50% on major commercial installs. You get 30% back, from the government on whatever you spend on residential. And there's all kinds of things. I'm not a tax expert, but I've seen the
Yep.
math. If you're currently
But
paying a
didn't they get
certain
killed with OBBA?
no, well, if you don't get it installed by the end of this year, but I
I think it
feel
actually
like
ends today. I think today is the deadline
oh,
because
it's today the
today is the
deadline.
deadline that ends for EV vehicles as well. So I think it's
Mhm.
actually today is the deadline. And
Okay.
I'm actually glad, and I'll use Kevin O'Leary's term, they took that thing behind the barn and shot it because green
It's the
energy is
debt that
bull.
always made it a problem. It's the debt that reason why it's a big pain point for us is because it's the debt on those solar panels that's tied to the properties, and then trying to sell them, and the value kind of gets wonky, and so on and
Yeah,
so forth.
it
That
it
makes
never it never balances out. And on top of everything else, you can't even use a VA home loan to buy a house with solar panels on it unless the previous person pays it off because the VA does not see the value in it. And so I don't know.
It's
I don't
probably the
believe in it
same with
either.
the FHA one. I've only been
Yeah,
caught with
FHA
solar
as
panels a
well.
few times where it became an issue, but usually it was is one didn't want the debt, and they wanted to give the debt to the buyer, or the buyer wanted
Yeah.
the seller to pay
Yeah,
their
the
own
debt
debt.
It's a
sounds terrible.
depreciating debt on top of a house.
Yeah. All right. Well, let's move on to interest rates since we were talking about that. No, not interest rates. Loan maturities and price drops. Okay. Peaking loan maturities are driving office sale prices down further. For distressed properties, is now the time to buy, or are we headed for a deeper crash?
Now is the time to buy it, and then maybe buy again when there's a crash. But I think that it's one of these things is you never try to catch the bottom. I think that there's some obvious value in these assets that people are looking at that maybe have significant vacancies. If you can see a path to absorption of that space, and you can and you put in some um, you put in some protections in your calculations, so some buffer, so that you can withstand maybe an extra 6 months of absorption. I think it makes sense to buy. And yes, the wall of maturities is coming, but it's all being unraveled in the back office now. Like nobody has blinders on, and tomorrow they open the door and go, "Oh, my loan is matured." I mean, they're planning for it. There's a lot of conversations between the banks or the private equities that are holding the debt and the owners. So, and there's deals being cut well in advance of the maturity. There are some people maybe that with blinders on that might get caught by a surprise, but I think it's rare with these types of commercial assets.
All right. Well, Joshua, that's actually the last question I had for Mr. Mark.
I just got one more for you, Mark, and because we want to be good stewards of your time. But
Yeah.
if you were making investment right now, from my view, it looks like multifamily is oversaturated in some areas. Industrial, which we really didn't get to, looks like it's cooling off. Retail is just kind of weird. If you were making an allocation of your own money right now, where are you putting it?
First off, retail is weird, and it will always be weird. Every single market has a different approach to it, and businesses are changing all the time. So I would not put it into retail. But I've been hearing a lot more about industrial outdoor storage. It's an industrial category that is mostly land, but can have some element of a building on it, like a distribution facility or a repackaging, art component to it, or just raw land that all of these tariff cars that all the local dealerships bought because the big tariffs were coming, so they bought up, all these cars and they're parking, outdoors. I think industrial outdoor storage, or IOS, is a very interesting category, and it's a small category right now. But that's where I'd be looking.
All right. Well, thank you.
All right. That's all I got, Joshua. And Mark, since you're the last guy here, what did you like to add? Do you have anything you want to put out or ask us or let the audience know?
No, I just wanted the audience to know, and I think you guys already know that BPM, our motto is because people matter, and we're here to help our colleagues, our clients, and our community in work and life. And we're CPAs, so talk to us a lot about finance, but we've got big networks and we can help. We are primarily real estate professionals. So it represents about 20% of the industry group within the firm. And obviously we've got our Silicon Valley significant component of our firm, but we're nationwide. We are up and down the West Coast, and we have offices abroad. So we just opened in the UK. So we've got a London presence, 4 partners there, growing again. We have a large Canadian presence, and can do a variety of services in Canada, and then a Cayman Island group. So if you guys need a hammock to lay in, I think we got one person out there to sign all of the hedge fund returns. But really, we have significant expertise with tax, the OBBA Act. If anybody needs assistance, navigating that, real estate experts to talk through everything that you can use there. And I'd love to talk to you, so you can reach me at mark@bpm.com, and we can chat.
All right. Thanks.
All right. Thanks, Mark. All right, ladies and gentlemen, if you like this video, hit the subscribe button, leave a comment below, give us a like. Please subscribe. With that, thanks for watching. Thanks for listening. See you soon.